Hello and welcome to another episode of Darwin Investors. Man, it was a wild ride in the market last week. We went up in a straight line, then we went down a straight line. But funny enough, at the end of the week, all three of the major indices actually finished up pretty flat for the week, which is kind of shocking considering the amount of volatility that we just had to endure. And we went up in a straight line because a lot of investors thought that our Fed would have to execute a pivot. And the reason why they thought we would have to do that because a lot of the global markets seem to be cracking. You know, we had the Bank of England that had to step in and rescue a pension fund. We had a large European bank that was alleged to maybe going through some financial distress. We had the Reserve Bank of Australia execute their own pivot. And so they thought that our Fed might pivot. And for these reasons, the market went up in a straight line. However, our Fed governors came out as the week went on and said, no, we are not going to pivot. We're going to keep on tightening. As a matter of fact, we're going to tighten and we're going to leave it there even longer than we said before. And for all of these reasons, the market started going down. Plus, we had the jobs data come out on Friday. And because our unemployment rate was lower than expected, the market actually crashed. And it crashed because we have this Fed that's using high unemployment and rapidly rising rates that are actually crushing economies around the world as a weapon to fight inflation. And all of this seems very counterintuitive to me, and I don't know why they think that high unemployment and rapidly rising rates that crush economies around the world is good for inflation, but apparently that's what they think. And I would love to be at one of their meetings sometime. I don't know, it's got to be very toxic that no one will actually step up, because I'm assuming that they don't work by themselves. There's some office and there's a bunch of people around, that nobody's stepping up and saying, hey boss, don't you think this is a bad idea? But maybe they're just like afraid that they're not going to get promoted. And what they really need is one of these bring your children to work days, so some 11-year-old will raise their hand and say, Dad, how in the hell is it that high unemployment and rapidly rising interest rates that are crushing the world economy is actually going to lower inflation? Can you explain that to me? Because I'm only 11 and I don't freaking know. And I would love that to happen someday, but they're not going to do that. But maybe they will. Who knows? Now, there are two things that are pretty obvious to me right now. One is that the risk of something breaking is definitely increasing. And the second thing is that the Fed is not going to stop doing what they're doing until something breaks, because forecasting things doesn't seem to be their strength. They were slow to tighten up things when the economy was screaming higher, and they're going to be slow to loosen when everything's dropping down. These guys are not forward thinkers. With all that said, we got a lot to get into this week. We've got retail investors leaving the market in numbers we haven't seen since March of 2020. We've got CPI data that shows up this Thursday. We've got earnings that start this Friday. And I also like to show you what I did last week, what my plan is going forward. And also, I'd like to show you some data from a hedge fund and what their plans are for this market, because I'm thinking it aligns very closely with what my plans are for this market. So let's go ahead and get into this. But before we get started in this week's episode, I need to first give a quick shout out to my sponsor. Guys, have you ever started up a YouTube channel and you were really happy about the people that actually watched it, liked, and subscribed? Especially people like Bob and Dave, who are really good about posting comments down there that give off some really good vibes and actually keep me going? Man, I have. And for that, I'm going to show you my sponsor this week, which is beer. Cheers, fellas. That's actually Freshies from Tonewood Brewing, which is right down the street. I love this beer, and I actually give it 4 Kate Roonies out of 5. Now let's get into this. So I really like this article here from CNBC Pro that came out on October 6th, showing that retail investors haven't dumped this much stock since March of 2020. And then it goes on to show exactly which stocks that they're selling. and it shows that retail traders were sellers of U.S. equities for a second week in a row, exiting $2.4 billion worth of single stocks last week, and that was according to J.P. Morgan. The last 2 weeks represented the worst selling in single stocks since March of 2020. The big selling came as extreme volatility gripped the stock market. The S&P 500 lost more than 9% last month as the Fed vowed to stick to its tightening path to fight inflation, stoking recession fears. The third quarter marked the first time in about 80 years where the S&P suffered a quarterly loss after being up more than 10% at one point. And the stocks that we're all dumping in mass, number one is going to be Apple. Number two was the S triple Q, which is the Ultra Pro Short Pro Shares ETF. It's a triple leverage ETF that shorts the NASDAQ 100. But I'll show you why they're dumping that one in mass, and I'll stick a video that I made about triple leveraged ETFs up here in this corner at the end of this video. But essentially what happens is that when you go into triple leveraged ETFs, the research that I did showed that when you lose, you do lose triple. But when you win, you only win double. And so in the end, holding on to these things any more than a day or two is just a losing venture. So this would be one that they would be shorting, and I could see that, or getting rid of, because it's a dangerous thing to get into. The next stock that they're getting rid of is Meta. The next one is Google, AMD, and then the long on the triple Qs, T triple Q. This one does the inverse of what the S triple Q does. Don't know anybody or any reason that I would ever own T triple Q, because the reason is if you just buy NASDAQ stocks and they go up, they're going to go up. Why would you ever have to buy one that's going to go up double if you're risking losing triple? It doesn't make any sense. So I don't know why anybody buys this one here. Occidental, Nike, Microsoft, and Nvidia round out the list of what retail traders are getting rid of. Now, of this list, I own Alphabet, AMD, Microsoft, and Nvidia. I am a retail trader, so I own a lot of these, but I have not sold them. Now, I can see why people would sell stocks, if I'm honest. Because let's say that you were up, say, you put in $100,000 and you were up to, say, $175,000. Well, let's say that from 175 you go down to, say, 120. Then you're down 50,000 from your all-time high, but you're still up 20,000 from what you put in. So you're technically not down. And then from there, you might go down to, say, 105. Now, remember, you put in 100,000. Now you're at 105. So you're still technically up $5,000. But I think what's happened in this week is people that may have put in $100,000 are now seeing themselves at like 97, 98,000. So now they suddenly have less money than what they put in to begin with. And this is causing people to pull their money out of the market because they're like, you know what? I at least want what I started with. And so I think there's a lot of that going on here. And I'm basing that on the fact that I actually went negative from what I put in the market as of like 2 weeks ago. Now, when you lose, like, let's say you go from like 170 down to 100, how long does it take to get you back up to 170 again? So this would be a pretty interesting exercise here. The market actually gains on average about 10% a year. So let's pull up a calculator. If the market goes up, say, on average 10% a year, after 1 year, you would be at 110,000. After 2 years, you would be up 121,000. After 3 years, you would be up 133,000. After 4 years, you would be up 146,000. After 5 years, you would be up 161,000. So it's going to take you 6 years just to get back to where you were in gains at the beginning of this year, given an average S&P appreciation of 10% a year. So the losses this year have been pretty nasty. And so what surprised me at all to see this S&P fall down a bit more and then to take about 6 years to get back to where it was, say, like 9 or 10 months ago. That wouldn't surprise me at all. Now, retail investors leaving the stock market isn't all bad because it gives us that are left over, us leftover retail investors, a better opportunity to short this market. So I'll give you an example. So like months ago when I wanted to short DWAC was sitting at $90 a share. But to short it at the money was going to cost me about $1,300. So that was a pretty steep price to pay. And with all of the active retail traders that were in the stock and in the market at the time, I didn't know if that thing was going to go up or if it was going to go down. So if you look at my positions this week, you can see right here at the top, I have shorted Twitter. I bought a put that expires on January 20th of 2023 with a $50 strike. I bought 2 of these and they cost me $615. So I bought 2 at the money puts for roughly $300 a piece. If this was months ago, this would have cost me a fortune. Now, Twitter's a decent company. It's not one that I would short if it was like at $30, but here sitting at $50 with an expiration date of January next year, and without all of the retail investor cover fire that had protected stocks just like DWAC, I'm not afraid to do this. As a matter of fact, I wouldn't be afraid to do it here at $420 per trade with this strike price and this expiration date. So what does this mean? Well, it means that I have 2 contracts of Twitter, which is essentially 200 shares of Twitter that have an expiration date of the 20th of January with a price strike of $50. So should Twitter go down to say $25, which is what I about think that it's worth, should it finish at $25 by the 20th of January, this contract, each one will be worth about $2,000 and I should get about $4,000. So I'll get $4,000. I paid $615 to get it, so I should net about $3,400. And this is why shorting stocks in an environment like this is very popular. You can make quite a bit of money. Now, Elon Musk is buying this company. In the past, retail traders would provide a lot of cover for any sort of stock that Elon Musk was involved in. But with retail traders out of the game right now, I'm thinking this is a fairly safe trade. And if you look at all the shorts that I had on Friday, you can see that on Friday I made $1,348 on my covered call positions and on the puts that I bought on Twitter. Covered calls are what I sold. I paid my way out of my NVIDIA covered call for $4 and netted, I think, about $85. And I bought 2 calls on Twitter. Now you can see that I made $1,350 on that day, but I'm only up $455, which means that going into this day, I was down about $800. So calls have, or options have a risk to them. But why was I confident that that was going to happen? Well, when I look at this right here, I had some indicators that I thought were pretty strange, being that bond yields were up. So on Thursday, bond yields were up like 16 basis points. When bond yields go up, equities become less attractive. And so I couldn't figure out for the life of me why the stock would go up. Oil was up on that day, and I couldn't figure out why, if oil was up and bonds were up, stocks would be up. It didn't make any sense. And last but not least, the FX here, the exchange rates, you can see that the dollar was strengthening versus the pound versus the euro. It actually was strengthening versus everything except for the Canadian dollar. And so with all that as a background, with the dollar strengthening, the bond yields rising, and oil going up, why on earth would equities go up? It seems like that what that was is a massive short selling covering. Like people were shorting stocks and they were covering, which was driving up the market because they were scared. I went ahead and held my ground because I was like, this doesn't make any sense at all. So I went from being down like 800 to up $455 or so. And so that's the way I'm playing this market. I'm basically shorting the stocks that I own, and I'm going to buy where the opportunity arises, puts on stocks that I think that are going to go down in the near future, especially if they're going to give them to me so cheaply, like this Twitter one. I wasn't going to have to pay $1,300 per contract like it was for DWAC. To do this for DWAC would have cost me $2,600. And so, of course, I didn't do that. So let's talk about why I'm shorting this thing and what I believe Twitter is actually worth. Now, Elon Musk himself doesn't think the company is worth $54.20 a share, or he wouldn't be fighting it in court and trashing it in public. Him trashing it in public has made it so that a lot of investors don't actually even want to invest in this company anymore because he's just drug it through the mud for the past few months. But now he's on the hook to buy this, and he says he's going to buy for $54.20 a share. But let's take a look at what it's actually worth here. And like I said, it's not a bad company. They don't currently have a price to earnings ratio, meaning they're not profitable at the moment, but they're expected to be profitable next year. That remains to be seen. Elon Musk has a lot of visions for this company, and they're going to be very costly. So that if they're going to profit next year, I would say that a lot of the things that he's planning on doing can't come to fruition this year because it's going to cost a lot of money. Growth forecast 101%, net profit margin negative 2.4. If you look at their income statement, you can see that their revenues are grow pretty consistently year on year, to where last year they made $5 billion. They have a market cap of $37.63 billion. What that means is that their price to sales ratio, which would be their market cap divided by their total revenue, is roughly 7. So their price to sales ratio is 7. So let's see how their price to sales ratio compares to others in their same market. Let's take a look at Pinterest. Pinterest is a company, they sell for $25 a share. Pinterest actually does make a profit. They have a price to earnings ratio of 63 with a forward PE of 43. Both are high, but it shows that it's a high growth company, but they are profitable. They have growth forecasts that is projected to shrink in the next 3 to 5 years, but a profit margin that's 8.1%. They do grow just like Twitter does year after year, with the latest year being $3.1 billion in assets and a market cap of 16.92. Let's call their price of sales of 5. Twitter was 7. So Pinterest sells at 5 times, and they sell for $25 a share, and they're profitable. Twitter sells for 7 times, they're not profitable, and they're selling for $50 a share. But the closest one to them would be probably this Snapchat here. Snapchat is $10.60 a share. Snapchat also is not profitable, is projected to be profitable just like Twitter is. They have a net profit margin of negative 18.31%, so they lose a bit more money than does Twitter, with a growth forecast that's actually also projected to shrink, whereas Twitter's is expected to grow. They have a market cap of $17.56 billion, and you can see that their revenue actually grows very similar to Twitter's, and their latest year was $4.1 billion, which would put their price to sales at roughly 4. If you take Twitter's price to sales ratio that is currently 7, and you go ahead and move it to exactly what Snapchat's is at 4, we'll get ourselves a decent idea of what Twitter is actually worth. So let's break out our calculator again. So what we're going to say is this market cap will shrink from 7 times sales to 4 times sales and come into line with Snapchat. 4 times 5 billion is 20 billion. So we'll say 20 divided by the 37 here, the 37 billion, means it's going to be 54% of what the current share price is, should be the price of Twitter. The current share price is $49.18. And it'll show that a very fair price for Twitter, if it's going to be priced exactly the same as Snapchat, and they're very similar companies, should be about $26. There are analysts out there that think that if Twitter wasn't backed by Elon Musk, that it would be in the $15 to $17 range. I tend to think it's worth a little bit more than that, as I do believe it is a good company. It does have some good growth prospects about it. And so I think that $26 is reasonable. And it's currently sitting at $49. And I think it's really reasonable given the fact that retail traders have left this market in mass. Now, as we know, this is a very event-driven market. You can see from Friday when the jobs data came out stronger than people had hoped for, that the market actually crashed. Now, this Thursday, no bigger event happens than our inflation data. The CPI read comes out on Thursday. And the forecast for this is that we're going to be sitting at 8.2%. Now, the month before it was 8.3%, before that it was 8.5, and before that it was 9.1. So this is a decline. However, it may not be enough of a decline to signal like, oh, the Fed is going to pivot. And it remains to be seen how people are going to react to this number. I mean, I don't really know. All I do know is that whatever the reaction going to be, it's going to be a reaction straight up or it's going to be a reaction straight down. It's not going to be nothing. Let's put it that way. So I would close all my options out before they release this number. And even if they said today, let's say they said today, and I knew it for a fact, today was going to be, say, 8.1% or 8.0%. Do I know which direction this is going to go? Because it might be that the Fed looks around and says, 8.0%, well, that's still really high. We're going to have to hike things up and keep it there forever. Or it could be like 8.0%. That's fantastic. It beat expectations and the market actually rallies in a big way. My money would actually be on the other thing, but we'll see what happens. In any case, I would close out any options that I had prior to Thursday because we don't have any idea what this number is going to do to the markets. Now, the stock market really dove last Friday because the unemployment rate fell to 3.5%. And the stock market views this as negative because it means that Jerome Powell is going to have to tighten even more. And so this data sent the market down. And what I think is funny is because like we're living in two different worlds right now. So you've got this one world where if you're not in the stock market, you feel like you can quit your job on Monday, you can get 2 or 3 jobs by Friday. Those jobs will pay you 20% more than what you make right now, and you don't even have to show up to work to get that money. So it's like I can't even imagine being somebody who owns a business right now, and you have you come to work and you flip on the lights and nobody else is there but you, and you have some employee telling you, hey, by the way, I moved to Billings, Montana. Can you send my checks there? I'm not a micromanager, but I at least want them in the area. You know what I mean? But that's the world we live in right now. And so we've got us stock market people. We're living in this world where everything is just crashing, and the rest of this world's like, oh, nothing's going on, and they're just whistling right past the graveyard. This is our own private hell. However, when they all see that this stuff is crashing and the unemployment rate raises to say 7 or 8%, we're going to be the ones in the market, and our stocks are all going to go up, and they're all going to be like, how come we don't have jobs anymore? And we're going to be like, I don't know, we have lots of money. And so it's just kind of funny. This is kind of the way that I think that the stock market, when it bottoms on good news and it goes up on terrible news. And now I'm beginning to see firsthand how this happens, but this is one way. Now, I think this is ironic that nobody could see this coming because just like a week earlier, we were showing that job openings dropped by 1 million. Now, where were these jobs that were opening? Where were they going to go? And what was going to be the end effect? Well, if people were getting jobs, you would expect the unemployment rate to fall. However, when this came down, this is, oh, that's great. We have less job openings than we used to have. It's like, yeah, I know we have less job openings than we used to have, but that means the unemployment rate's going to fall. So you tell me how one falls while the other one doesn't go up. And the only way that's going to happen is that if the number of job openings just simply decline, like the companies just stop hiring people. That's the only way it's going to happen. And that's going to cause a recession, and that's going to cause inflation to go up. So it doesn't make any sense to me, but that's finance for you, I suppose. But I would argue that having the unemployment rate go down is really not that bad of a thing. And so with this article, it's saying that good news is still bad news for the stock market, but there is a silver lining to Friday's strong jobs report. And the silver lining is that the continued economic strength should lead to a better earnings season. This all makes sense. However, we, understand that just because something was really good in the past, it may not be good in the future. The Fed does not seem to understand this. So what this article is saying is that we could see very good results with revenue and earnings. However, we may not see that good of guides. And the stock market is going to price in guides. And the Fed is going to price in revenue and earnings as it happened in the last quarter. So this kind of leads to sort of like a perfect storm of garbage. So we're going to see what actually happens through this earnings season. However, historically, the fourth quarter of every year has been a very positive quarter for equity markets. So we may see banks and hedge funds moving into riskier assets, even as their guides may not be that positive, given the fact that that's just the kind of thing that happens year to year. It's sort of like the way that they move into Hershey's and Coca-Cola and Pepsi in times of inflation or possibly recessionary forecasts, because those are considered consumer staples. Now you tell me how Pepsi and McDonald's is a staple. I don't know. I could figure out a way to do without it, but apparently it's a staple according to the stock market, and you need to go into it just in case things go a bit pear-shaped on you. Which brings me to this article that I've just been dying to share. So it's this company, this Vetify, and it's this ETF strategist channel. I've never heard of it before, but I thought this was really interesting, where it says the stock market panic stops when central bank panic starts. So should they be tightening so hard and everything goes right down the drain? That's when the stock market's going to be happy. That's why I was saying that we're living in this world that the rest of the world doesn't live in as investors. And when the central bank starts to panic because everything's gone right down the toilet, that's when the stock market's going to actually pop. Now, what are they going to invest in? I think this article is very worth going through as a retail investor. So we believe the Fed has just made a big mistake. The 75 basis point increase was already priced in, but Powell seemed to indicate that a crash landing is unavoidable. The approach he should have taken was to acknowledge that some economic and inflation indicators are showing weakness, and maybe a near-term pause would be in the cards. This is exactly the way I feel. I don't work for this company, but I'm telling you, if I had written this article, it wouldn't have been written any differently than what this one is written like. Most of the forward-looking inflation indicators we look at are falling, and some quite rapidly. Hiking aggressively while the economy is slowing is rare. Typically, monetary policy becomes tighter when the economy is expanding. Most of what you will read will be negative and bearish. Those suggesting that you buy are few and far between. However, the time to be bearish was when CPI doubled, the economy was booming, and the Fed was still buying bonds while holding rates at 0%. These were signals to de-risk. Man, that can't be worded any better. Astoria believes we are close to the end of this tightening cycle. Not sure. Will inflation stay structurally higher and for longer? Sure. That's the reason why I wasn't sure that we were at the end of this tightening cycle. We believe we are 75% through this market downturn. When the Fed panics, usually we're close to the end. Because of Powell's tone at the press conference, we see a scenario where the market may bottom around 3,200 on the SPY. Just remember, as markets correct, valuations should improve and forward returns become more attractive. It makes sense to be incrementally more bullish as the market goes lower. True. Investors and market pundits seem to be doing the opposite. True. That's the reason why all the retail investors left. Astoria prefers dividend players, value over growth, and defensive quality stocks. We are finally warming up to bonds after years of shunning the asset class. We are buying laddered US Treasuries, IG credit, and munis, all short dated paper. So this company is suggesting that you go to dividend players, value over growth, and defensive quality stocks. Now, it's going to require a shift in my own personal strategies because right now I'm all growth. But I can see that if these things keep tightening and if this earnings season doesn't go as I hope, that maybe I would exit my current positions and start going into these equities right here. I can also see where larger hedge funds and banks are going to ditch certain equities and go after bonds, treasuries, and municipal bonds, all short dated. They're going to want the 2-year variety. They're not going to want the 10-year. They're going to want the 2-year. And they're going to anchor these holdings with a smaller portion of equities. Now, I'm personally not going to do this because a 4% increase on my portfolio every single year for the next 2 years doesn't excite me. But if I had many millions of dollars, 4% is not bad of return provided it's guaranteed. That's called investing. I'm a gambler, they're investors. So here is a take-home message for this video. We know that things could still go down. So there's a retest process that is still underway. We know this is a very event-driven market. Every little bit of macroeconomic data can send this thing up in a straight line or down in a straight line. And we know that when this happens, it happens really fast. And it does happen in both directions, as evidenced by this past week. We know that there are risks out there that could break the global economy. And we know that it's being caused by our central Fed here in the United States. As such, it seems that the Fed may be forced to pivot to keep other economies, if not our own, in balance. It's looking like inflation should ease between now and next year. And it also looks like with our own portfolios, we should maintain a bit of flexibility to know, do we want to go into bonds? Do we want to go into corporate, investment grade bonds? Do we want to switch our equities from where we are now in growth? Do we want to go into value? Do we want to go into dividend stocks? These are things that we want to assess as this earnings season progresses. And this is kind of where we want to be as retail investors. And so what I'm going to end up doing is I'm still going to carry on the stocks that I hold at the moment. I may unload them all. I am going to need to tax loss harvest because I did make quite a bit of money on my options this year and buying and selling stock, but I've lost a lot of money on the stocks that I currently hold. I may just do a complete portfolio overhaul, go into some of the that Vetify had suggested, dividend players, value over growth, defensive stocks. I won't be going into treasuries or bonds, even municipal bonds or corporate bonds, even if they're investment grade. These are not things I'm interested in at this time. I am going to be shorting stocks that I think will probably go down as the as the opportunity arises. And these are all things that I plan on doing going forward. We'll see how this earnings season goes. Either way, I'm going to have to unload a lot of stocks in order to tax loss harvest. I'm probably going to go into different equities when that happens. I may overturn the entire portfolio. We don't really know. Even I don't know. I'm going to end up shorting stocks if the opportunity arises, such as I did with Twitter. If something else comes up that I think looks like something that I'm going to short, I'll certainly let you all know. And if you do want to know, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.